Hello, everyone. My name is Nathan Corroy from Richardson Financial Group, and I'm joined by Dan Brown, our Director of Investment Management. And we are here today with the Economic and Investment Update for the third quarter of 2024. Dan, in the third quarter, we saw continued strong performance in the financial markets, both with equities and fixed income posting positive returns. On the equity side, we saw positive returns in all 3 months of the quarter. And in fact, we saw major indices reaching all-time highs later on in the quarter. We saw small cap stocks kind of take a leadership stance within the markets, being that those are very interest rate sensitive, and we'll talk more about rates later on today. But do you want to give us a little bit backdrop on what we saw in the fixed income markets and maybe in some specific sectors of the market?
Sure, Nathan. So the fixed income market kind of resembled what we saw in the stock market. So as you mentioned, the stock market was up very strongly, up all 3 months. Similar story within fixed income. So as interest rates declined during the quarter, we saw fixed income post very solid returns. In fact, one of the strongest quarters we've seen in many years. Again, investors were responding to and the anticipation that the Fed would begin cutting interest rates. And sure enough, we saw that in September. We'll talk about that in a little bit more. And just the last comment on fixed income, the part of the fixed income market that's performing exceptionally well is corporate bonds.
Mhm.
So corporate profitability remains very strong, and that's being reflected in strong returns for corporate fixed income.
And as we've noted, one of the biggest issues impacting the financial markets lately has been the impact of interest rates and the Federal Reserve's decision to lower those rates. Now, we saw the Federal Reserve, kind of holding an elevated level of rates all the way back since last July. And at the meeting in middle of September, we saw them make the first interest rate cut, which was a 50 basis point cut to interest rates, which was probably widely expected by the financial markets. How should investors be thinking about the implications of that rate cut that we got in September, and maybe more importantly, what we're seeing for the future of rates going from here?
Yeah, so we expect more cuts to come, and the Fed signals this via their dot plot projections. So every other Fed meeting, they put together their expectations and they put those out in the form of a dot. So the graph that we're showing is what these dot plots reflect. So each dot reflects each member's expectations for where they think Fed funds will be at any certain point in time. And then we graphed it out with the blue line here, and you can see what the Fed is expecting as far as interest rates for Fed funds. So it very clearly shows that we should expect another half a percentage cut this year, so 50 basis points, and then more cuts to come into 2025 and 2026. So as you mentioned, Fed funds has been kind of high, elevated at a 23-year high and somewhat restrictive, been slowing down parts of the economy. So we think that things should improve in the economy, namely anything housing related should improve. So we feel pretty good that the Fed will deliver on these Fed rate cuts as long as inflation doesn't reappear. And the other thing that we notice, which gives us some comfort, is just looking at what's being priced into the financial markets.
Mhm.
The financial markets are also reflecting what the dot plots reflect. So we take that as a very positive signal.
And Dan, given that outlook on interest rates going forward, I think a key question on a lot of investors' minds is kind of what does that mean for my portfolio and how should we expect the market to perform from here? We see a lot of keywords in the financial press about whether or not we're in a soft landing or a hard landing scenario. Do you want to talk a little bit about kind of what our research has shown with regard to, market performance in each of those scenarios as we enter a rate reduction cycle?
Sure, Nathan. So those outcomes are distinctly different. So you talked about that hard landing outcome. That's synonymous with a recession.
Mhm.
We don't think we're there. We think we're more in the soft landing camp. We actually think that's playing out right now. So we feel pretty good where we are from an economic standpoint. And given the fact that the Fed is now being accommodative and easing, we feel pretty good about the outcome. So the research that we're showing is that the outcomes for the stock market are distinctly different depending on what type of scenario we're in. So with that soft landing scenario, which we think we're in, we actually get positive returns out of the stock market. And that kind of makes sense. So what we see is, earnings growth is still pretty decent for corporations. As we talked about, interest rates are coming down, and so is inflation. So we think inflation is trending towards that 2% goal for the Fed. That hard landing scenario, we think we're far from that. So again, that's a recessionary type outcome. We think we're going to get positive growth this year for the economy, probably around 2.5%.
Mhm.
Next year, probably still positive. So we feel pretty good about the outcome and what our research shows for the stock market going forward.
And Dan, given that overall backdrop of continued economic growth, lowering inflation, kind of entering this interest rate reduction cycle, seems clear that we're fairly optimistic about the financial markets, kind of going into the end of the year here. What do you see in terms of changes to the portfolio that we've been doing recently and or maybe anticipating, and how do you kind of see things ending the year?
Yeah, so regarding that optimistic outlook, which we've had for a while,
Mhm.
mainly because we figured the Fed would be cutting rates by now, we figured that soft landing scenario was playing out. The past couple of months, you've seen us in our discretionary managed portfolios either sell completely or greatly reduce our money market position because we thought, again, rates would go down and earn less in the money market. And in the more conservative portfolios, you've seen us buy fixed income. So we think fixed income, the backdrop is, pretty solid for further gains. And in the more growth-oriented portfolios, we've bought stocks. So again, feel pretty good about both groups going forward, both stocks and bonds.
Well, with that, we want to thank you for watching. As always, feel free to share this with anybody that you think might find value in it. And of course, we appreciate your continued trust and support, and feel free to contact us with any questions.